Yes, we can hear you,
Yes,
sir.
good evening, sir.
All right, thank you all. Of course, we have to try and round up on, we are on transfer pricing. Transfer pricing policy. Let us do a summary of the topic. Transfer pricing is about a price paid by one division and received by another division of the same organization. The transfer price paid by division A to buy goods or service from division B. Both divisions belong to the same organization. Division A and Division B belong to the same company. The company is operated along divisional structure. So when we say transfer price is for internal transaction, where one division is selling to another division. These divisions are profit centers or investment center. What that means is that these divisions are established to make profit. In other words, each division will try to maximize its profit because divisions will be evaluated on the basis of profit performance. So each division will try to maximize profit. We explained this. We now said transfer price should be done in such a way as to encourage divisions to transact business with one another. Division A should be willing to transact business with Division B. Division B should be willing to transact business with Division A. There should be encouragement, motivation, but not mandatory. Division should have independence and autonomy. Divisions are established as an independent company. Hence, they must be given the freedom to do what is right. However, this freedom should not be abused. Division should be given freedom to be able to take decisions and use their initiative. However, this freedom or independency should not be abused. Divisions must remember that they report to the corporate head office, and divisions must work in the best interest of the company as a whole, so as to avoid suboptimality. What is suboptimality? A situation where divisions are taking decisions that are not in the best interest of the company as a whole. This decision may favor the divisions. This decision may be favorable to the division, but not good for the company as a whole. This is what we call suboptimality. That is dysfunctional decision making. We explain this, and we discuss the various types of transfer pricing. Money, cost-based transfer price, market. That was a temporary glitch. So we discuss cost-based transfer price, market-based transfer price, negotiated transfer price, arbitrary transfer price, and transfer price based on opportunity cost. We discussed this. Thereafter, we solved question number 3 last week. We treated question number 3. That should be page 93. Now let us look at more questions. If you have to solve 2 questions, we are starting with question number 1 today. Please refer to page 93, question number 1, or page 92. You are going to see Eco Industries. Can somebody reconfirm the page?
Page 91.
Oh, page 91. Thank you. Please check page 91, question number 1. Let us look at this question together. The question we solved last week was ACCA tested. This question number 1 was ICAN tested. All right. We move to this question together. Eco Industries is a decentralized organization with 6 divisions. The company's electrical division produces a variety of electrical items, including an EK10 electrical fitting. The electrical division is operating at full capacity. Full is missing here. At full capacity. And sell these fittings to its regular customers for $750. The fittings has a variable production cost of $425. The company's brake division has asked the electrical division to supply it with a large quantity of EK10 fittings for only 500 naira each. The brake division, which is operating at 50% of capacity, we put the fittings into a brake unit that it will produce and sell to a large partial motorcycle assembly company. The cost of the brake units being built by the brake division is as follows. Purchase parts from outside vendor. We have the price. Electrical fitting, EK10, 500. Other variable costs, fees, overhead, and admin. Total cost per brake. Although the 500 naira price for the EK10 fittings represents a substantial discount from the regular price of $750. The manager of the brake division believes that the price concession is necessary if the division is to get the contracts for the motorcycle brake unit. Please, just 1 minute. Can somebody reshare the study pack? A student is requesting our assistance. I've been trying to reshare.
Sir, it has been
Please,
dropped on the group.
Yes, to the group.
Yes, sir, I've
Oluchi
dropped it. Somebody else too has dropped it.
Okay. Okay. Maybe it's my network. I've been trying to share, but my network has not been going. Right, that's fine. That was what I was trying to do while my reading was slow. All right. He said, okay, let me take it again. Because this break, I don't like it. Although the 500 naira for EK10 fittings represent a substantial discount from the regular 750 price. The manager of the brake division believes that the price concession is necessary if the division is to get the contracts for the motorcycle brake units. He has heard through grapevine that the motorcycle assembly company plan to reject his bid if it is more than 5,000 naira. This should be 5,000 naira. Our brake units. Thus, if the brake division is forced to pay the regular 750 for the EK10 fittings, it will either not get the contracts or it will suffer a substantial loss at a time when it is already operating at 50% of capacity. The manager of the brake division argues that the price concession is imperative to the well-being of both the division and the company as a whole. Eco industry uses return on investment to assess divisional performance. Now look at the whole story. The whole story is eco industry is divided into two divisions: electrical division, brake division. Electrical division manufacture electric fittings, EK10, which is sales to external customer as well as to brake division. Normal selling price is 750. Now, brake division is asking that electrical division, please sell to me at 500 naira. What I can sell for 750 outside and make my profits. And my performance will be based on return on investment. That means the more profit I make, the more my performance will improve. Now, somebody within brake division is asking me to sell electrical EK10 for 500 naira. Now, look at requirements A. Assuming you are the manager of electrical division, will you recommend that your division supply the EK10 fittings to the brake division for 500 naira each as requested. Why or why not? Show your calculation. The question is to the class. Will you recommend for your division to accept 500 naira? What you can sell aside for 750? Let me hear from you. Gabriel.
Yes, sir.
Will you recommend that you should accept 500?
No.
No. Why?
Because if it sell it outside, it's going to make more profit at 750.
All right. Philip, your opinion, yes or no? Then support your answer with explanation.
Okay, sir. It will depend on the firm or organization policy. That is, if the policy of the firm is that they have to sell to their sister division, which is manufacturing, then they have to sell to them first before they can sell to outside supplier. So it depends on the business policy.
All right. Your approach is wrong. Examiner says you are the manager of electrical division. The question is pointing to you now. It's not dependent on any policy now. You are the manager. You are the overall head of electrical division. Examiner says, will you recommend for your division to sell at 500 naira what it can sell for 700? So there is no dependence here. It's a direct question. I think I saw two hands up.
Okay, then the answer should be no.
Person... Okay. All right. Olamilekan, Favor, your comments.
Yes, sir. I get that if we should consider the selling costs to outside.
I can hardly hear you, please. Can somebody hear him?
Can you hear me now? Hello?
Yeah, please go ahead. Please go ahead.
If we should consider the selling costs to outsiders, maybe that information could help us to get it. Selling to outsiders is not that selling to the
all right, thank you. All right, thank you. Can mute. You don't have any. Examiner has given you the price for outsider. Outsider will buy from you at 750. That is the regular price. So the appropriate answer is no. I will recommend for my division to agree to a price of 500 naira. What we can sell for 700 naira to external customer. What we can sell for 750. So please, in exam, don't create unnecessary issue. Examiner has given you a question directly. He said, assume you are the manager. That means you are now the overall boss. As far as that company is concerned, you are the manager of that division. And if you agree to 500 naira, that means your division will lose 250 the profit of your division will reduce by 250 naira per unit of items, sold to break division. So please, when you get to exam, do not create avoidable issues. Examiners ask you a direct question. Please answer directly. I will come here. Place this. I'm trying to place the margin. Yeah, okay. Now let's go to this. Let's go to this. Please allow me to copy the question. I want to copy the question closer to the answer. Please, your exam is approaching. What that means is you need to define your strategy. The strategy you are going to use to read and secure sufficient mark. So we come here. So please define your strategy. So we come here. Let me take my pen. Look at the calculation. Electrical division. Let us use arrow.
Nous avons quitté Cotonou fin 2015. Les routes étaient encore caboteuses, la ville était sale. Les gens
Please, can you mute Mr. Gabriel?
Yes, sir. Sorry, sir. Sorry, sir.
Look at electrical division. If I say to external customer, says external customer, then break division. If I say to external customer, my selling price, sales price, 750. If I say to break division, the price is 500. My variable cost of production, 425. My variable cost of production, 425. If I sell externally, contribution I will get 750 minus 450. Please, can somebody help me with this?
$325.
I'm going to get a contribution of 325. If I said to break division, I will get a contribution of 75. That means if electrical division agrees to a price of 500 naira per fitting, the division, if electrical division, the division we lose difference 325 minus 75. 325 minus 75. What do you have, please?
250.
That is
250.
250. The division will lose 250 naira per fitting sold to break division. In this case, I, the manager now, I will not recommend my division to agree to a price of 500. You are done with A. Mishak, you are just joining the class. We are solving question 1, page 91. You have resolved question number 1. Something like this was tested last diet. Maybe after the class, please try to look at past questions. After the class, check last diet PM. Something like this was texted. So please, don't bring, it depends on company policy. It depends on, examiner gave you a direct question. Assuming you are the manager. If I'm the manager, I'm the overall head of this division. And I'm aware that my performance is based on profits generated. Why will I agree to a price of 500 naira when I can sell the same product for 750? Is that clear, please? Now we move to requirement P. So please, when you are giving direct question, don't create any complexity. Requirement B. Let me copy this also. So that when you are looking at the solution, you are also having the requirement closer. Requirement B. I'm trying to bring the question, requirement B question closer. Our examiner says, will it be profitable for the company as a whole? For the electrical division to supply the fittings to brake division if the motorcycle brake can be sold for 5,000 naira. Show your calculations and explain your answer. Let us explain these requirements. Brake division requires EK10 fittings to complete its brake. When the brake is to complete a brake unit, when the brake unit is completed, brake division will sell that brake to an external customer for 5,000 naira. Now the question is, will it be profitable for the company as a whole? Now the question has changed. It's not looking at company's perspective. Question A looks at divisional perspective, where decisions are taken from the viewpoint of the division. Now, question B, decisions will be taken from the viewpoint of the company as a whole. Remember, if electrical division sell fittings to brake division, electrical division will generate income, sales income. Brake division will incur purchase cost. The sales income is equal to the purchase cost. So the company as a whole, this transaction will have zero effect, regardless of the selling price. Electrical division will sell for 500. Brake will buy for 500. 500 selling price, which is for electrical division. 500 cost price for brake division. 500 minus 500. So the company as a whole, they are going to get zero. Now, is it profitable from the company's viewpoint? Let's check this out. You are going to answer the question yourself. But I'm going to assist with the required calculation. Company's profits. Not price, profits. Company's profits. We have brake division. Brake division. Selling price of brake A brake unit, 5,000 naira. Selling price for brake, 5,000. Now, relevant cost. Relevant manufacturing cost of brake. Let's go to brake division. Purchase parts from outside vendors. That means brake division, we purchase parts from outside vendor. This is relevant. We require parts, 2,250. Purchase parts. $2,250. Next. Electrical fittings, 500. Brake division, we buy fittings at 500 from electrical division. That means brake division, we incurred 500 naira. Electrical division, we receive 500 naira. Will this affect company as a whole? Will this transaction affect company as a whole? I want to hear from you.
No, sir.
No. This transaction is not relevant to company. It is relevant to individual division, but not relevant from the company's perspective. You are going to disregard interdivisional transaction when you are looking at company's perspective. So we ignore this. Other variable cost. Other variable cost is relevant. Other variable cost, 1,400. Next. Fixed overhead and admin. The fixed overhead and admin. Is this cost relevant or not? Let me hear your opinion. You have done relevant costing. No. Whether brake division accept the contract or not, the admin overhead cost fees still remain fixed. Now return here. These are the two relevant costs. Please sum up 375. Total relevant cost 3,750. The difference between these two, Contribution per unit. Per break.
250.
Oh, this is 6, Abi. 36.
Okay.
$1,350. That means the company as a whole will generate a contribution of $1,350 for every unit sold externally by break division. That means the profit of the company as a whole will increase by, there's still one more thing we should consider. Remember that if break, there's still one more thing that I think is relevant to us. One more thing. There's still one more thing. Let me bring it here. There's still one more thing. Now, electrical division, we lose 250. What it should have sold to outsider for 750 is selling to insider 500. That means the company as a whole in fact, look at it. Look at it. By selling internally for 500, electrical division is losing 250 naira. That means the company, because electrical division is also part of the company, that means the company is losing 250. That gave rise to opportunity cost. You have a choice between selling externally and making 750 or selling internally and getting 500. That means there's opportunity cost of 250. Look at its contribution loss by electrical division. This thing should do fast. My system is trying to save. This is what I'm trying to say. Look at this. Contribution loss by electrical division. 250. Now add these three together. No, that money loss. Electrical division cannot sell outside because it's now selling inside. That means the company as a whole, we are losing 250. Fashion it in here. Because we want to sell to break division. As a result of taking that decision to sell to break division, we are foregoing 250 naira we should have gotten by selling electrical units to outsider. Please add these three together.
39.
We have 39. I have 250 here. 3,900. Now profits or contribution. $1,100. That means total profit of the company will increase by 1,100 naira per unit, per break unit. Let me write it. Profits of the company will increase by 1,100 per break units sold to outside customer. Outside customer. Hence, it would be profitable for the company as a whole if electrical division accepts the price, accept 500 naira, accept 500 naira for EK10 fitting. You are done with requirement B. Please, if there's any area you don't get, ask your question. Yes, Misha. I can hardly hear you. Are you speaking to the class?
Hello, sir. Good evening, sir.
Yes.
Just for more clarity, because transfer pricing is very technical. So is it because we are doing as a whole for the company? That's why we brought this, we are putting that 250. That's the price, the opportunity cost of selling to outside, which is the 750 minus 500 to get 250.
You are very correct.
So we are calculating for the company,
correct.
not division.
Yeah, it's because you are looking at it from the company. Okay, look at it this way. I agree with you that transfer pricing is a bit, it requires a lot of reasoning.
Yes, sir.
Our company as a whole, we have two divisions. Electrical division we sell for 750. That division is operating at full capacity. That means that division can sell all its products outside. That division we sell for 750. We now have the division to transfer at that division. We sell to outside customer for 750. We now have the division to transfer to break division at 500. That means company as a whole, we are losing money. By transferring to break division, we cannot generate a profit of 250. Now, if brake division now manufacture its own product that is going to sell to outsider, we need to fashion in that money the company has lost, that 250 we have lost, that we cannot get from outsider. That is opportunity cost. It is because we are looking at it from the company's perspective.
Sir, I understand that aspect, sir. Is the brake division the company as a whole?
I didn't get that.
Is the brake division referred to as the company?
No, please.
But
Brake
from
division is a division under the company.
But they said the cost of the brake unit being built by the brake division follows. That is under this purchase part from outsider. Electrical fitting kit to 500 is like they're under the brake division. That's my confusion. If you check the second paragraph.
Okay. Let's analyze it. Let's
The
analyze this more. Please, hold on. Let's analyze this more. You are the manager of brake division. To manufacture your brake, you require purchase parts from outsider. That will cost you 2,250. You also require electrical fittings, which you are going to buy from electrical division. That will cost you 500. You're also going to incur variable costs, other variable costs of 1,400. Is it getting better? That means as a division, your cost, purchase parts, purchase from outside vendors, electrical fittings, purchase from electrical division, other variable costs incurred. This represents your own cost structure. We now have electrical division. Its own selling price is 750. Its own variable cost is 425. Now, two of you are under the same company. Look at it too. Let me do something here. Eco Industry. This is the company divided into electrical division and brake division. Information about electrical. Selling price for electrical division. External selling price. $750. Internal selling price. $500. Variable cost for electrical division. Variable products cost. $425. This information is for electrical. For brake division, its own selling price, external, Break division sell externally. Selling price is 5,000. Okay, let me, because of space, I want to show the items. Because of space, let me now come to electrical break division. Break division now. External selling sales price 5,000. Internal purchase price, purchase cost, internal purchase cost 500. That internal purchase cost is the cost of electrical fittings. Now, purchase parts from outside 225. Other variable costs for brake 14. Fixed overhead and admin 800. This information is for brake. Above is for electrical. Now, look at where we are coming from. If electrical division want to sell its products, the product is EK10 fittings. It can sell to external customer for 750. And remember, the only time the company will make profit is when you sell externally. It's given in the question. Idioma, check the question. 5,000 selling price for brake is in the requirements. Now, if electrical division want to sell externally, it's going to sell for 750. If you now decide to, that means the company will make a profit. As soon as you are selling to outsider, that is where the company has said, oh, we make profit. What you can sell to outsider for 750 and generate a profit, you now sell to break division for 500. That means we cannot realize that profit from the external customer. Now, if you now transfer at 500, brake division will now manufacture brake and sell to its own external customer, who is going to buy brake. The question now is, are we not going to consider the money we have, the profit we have lost, that we cannot get from external customer? Misha, are you there?
Sir. Yes, sir, I'm here.
My question is, are you not going to consider the 250 you are going to lose that you are supposed to get from external customer?
Yes, sir. Since we are considering the company as a whole.
Of course, the question says, would the company as a whole be profitable? It's your question that makes me to go through this route. Where's my... So, the company as a whole, we said, definitely the profit we are going to get from break must also cover what we are going to lose, what electrical division will lose. Both division belongs to us. So if electrical division is losing money, it is the company that is losing money. All right. So please get that concept in. If Dangote Cement is losing money, who is losing money? Dangote Group. Dangote Cement is a division within Dangote Group. If Dangote Cement cannot sell cement externally and Dangote Cement is losing money, it is the company as a whole that is losing that money. So it is reasonable to consider what that division is losing. All right, please give me like 1 minute. I'll be back. We now look at requirement C and requirement D. I will be back. So please, concept of opportunity cost is relevant to decision making. Requirement C. In principle, should it be possible for the two managers to agree to a transfer price? To agree to a transfer price in this particular situation. Examiner said, in principle, should it be possible for the two managers to agree to a transfer price in this particular circumstance? If so, within what range would that transfer price be? Would that transfer price lie? Let's take that again. In principle, should it be possible for the two managers to agree to a transfer price in this particular circumstance? Yes or no? If yes, within what range would that transfer price lie? Let me hear from you. Can the two managers agree to a transfer price in this particular circumstance? Yes or no?
Hello,
Michelle,
sir.
can you speak it?
Yes, sir. The both manager cannot agree on the same price because the electronic division, he transferred at variable cost plus opportunity cost. So he has the potential of selling to outside customer. So definitely won't agree at 500, and rather he will look at the opportunity cost he's going to miss if he sell at 500. And the break division will not agree to buy at 750.
All right, thank you. They can transfer price. Now, what is the particular circumstance? Electrical division can sell for 750. Break division want to buy for 5. Examiner now says, in principle, should it be possible for the two divisional managers, for the two managers to agree to a transfer price in this particular circumstance? If so, within what range would the transfer price lie? Michelle say no. Any other opinion? Any other opinion? All right. The correct answer is yes. They can agree to a transfer price. That is negotiated transfer price. The correct answer is yes. If you have to respond to this correctly, why not? We can negotiate. Yes. The two managers can negotiate and agree on a transfer price. This will range. Between regular price of 750 and variable cost of variable cost of manufacture. To 5. The maximum price will be 750. And the minimum price will be 425. That is the range. How do we determine this? The maximum price, break division we pay. The maximum price, break division we pay is 750. The minimum price, electrical division we accept is 425. That is your variable cost of manufacture. We are not saying this is the range between 425 and 750. The two managers will negotiate a transfer price. It will cost electrical division 425 to manufacture the electrical units, electrical fittings. And it can sell for 750. The two managers will now negotiate a price between 425 and 750. It cannot be less than 425. It cannot be more than 750. Within this range, a price will be agreed between the two managers. I'm coming, Mishak. So if you are asked, within the context of this question, one person wants to sell for 750. One person wants to buy for 500. You are now asked, is it possible to negotiate a price? Negotiated transfer price is between the variable cost of manufacture and the regular price of the product. All right, Bishop, your question, your comments.
So I just realized this question is the same as when they answers for the minimum price and the maximum price, because the minimum price is always the variable cost and the maximum price. This same question with November 2022, question number 4, because I've solved that question before. That was I was saying earlier that transfer price is kind of very technical, but because in that question, the answer of the minimum price, what would be the minimum price and the maximum price? And the minimum price was the variable cost, and the maximum price was the variable cost plus opportunity cost, which is the same thing you did here. But my question is, if they put a disclaimer by that if both divisions are profit center, will it still be the same?
Sorry, take that question again. I was trying to get my earpiece. Your question, take that question again. That's your question.
Okay, I was now like the 2024 question was minimum price and variable. 2022 question 4, the answer of the minimum price and the variable cost. Now the answer here is the same way.
That line is
So my
breaking.
question now is, if they are profit, hello sir.
Yeah.
If they put a disclaimer that both division are profit center organization, will it still be the same respond?
Of course, even this question, both divisions are profit center. We are not saying, please listen, Misha. We are not saying charge 425 or charge 750. Within this range, you know the price you are going to accept. It can be 600. It can be 650. The two managers we discuss. Examiner is aware, said, he didn't say give me a specific price. Give me a range. He said, give me a range. Your range will be between your cost, your variable cost of manufacture and your external selling price. That is the range at which negotiated transfer price will be agreed. The two managers will now discuss that, look, if I manufacture this product, it's going to cost me 425. And you know I'm a profit center. If I sell it outside, I will get 750. So if you are going to negotiate, how much do you want to pay me? The manager can say, okay, please let me pay 500. I say, no, okay, pay 650 or pay 600. But you have established a range within which discussion will take place. That's why when it comes to that solution, the ICAN solution, ICAN has given position. It's a group of accountants that come together and service. And is available. However, when you are using it, you are going to first of all look at the principle. At any point in time, a particular solution conflict with principle. We are going to drop that solution. We are going to follow principle. Like when you engage me, look at solution. Solution they gave us for ever. 2019 is different. 2022 is different. 2019 is different. 2022 is different. 2024 is different. But when we come back, we now speak to our principle. All right, let's round up this question. You are encouraged to check last direct question. I think question number 6 or so. Transfer price was tested. Maybe it will be tested this direct or not. Nobody is sure. But it was tested last direct for 15 marks. The last requirement. All right, look at the requirements. Let's expand this more. Please hold on. What happened? Oh God. Oh. People thank God today. Yesterday class, the network was really something else. Examiner says, discuss. Why now? I'm trying to expand this thing. Please, let's go on. I'm tired with this. Discuss the organizational and managerial behavioral problem. Managerial behavioral problems, if any, inherent in this situation. What will you advise the company CEO to do in this situation? What is that managerial behavioral problem that will arise if any inherent in this situation, where the two managers cannot agree a price?
Probability.
Where the two managers, two of them going to negotiation, and the range is between 425 and 750. Now, if the two managers cannot agree to a transfer price, what will be your advice to the company CEO to do in this situation? Bearing in mind that both managers are human beings. You want to pay me, you say you want to pay 500. I said no, I want to sell for 700, 750. And two of us cannot agree a price. That means there will not be transaction between electrical division, and brake division. If there is no transaction between the two divisions, that means brake division will not be able to manufacture brake and sell to fulfill the contract. Obviously, there's inherent problem. So my question to you is, what would you advise the company CEO to do? Yes, any opinion? Finish.
Okay, sir. My opinion is that the company CEO should set a price between the two divisions to resolve the enterprise conflict.
I think I lost that. Sorry, Philip, I think I lost that.
I
Please
said that.
just
Can you
hold
hear me
on for
now?
me. Please hold on for me. Let me quickly fix this. I can hear you now.
Okay, I said that the company CEO should set a price between the two divisions in order to resolve the enterprise conflict. That is the price that the company
You are right. The CEO will need to take a decision. Let's comment and leave this question.
But sir, it's like this question is more of relevant costing.
What do you say, Gabriel?
I think this question is more of relevant costing than transfer pricing, or the two.
It's one of what?
It's more of relevant costing than transfer pricing.
Why do you say so? It's more of transfer pricing principle. Where the two managers could not agree a transfer price, there will be no there will not be, or there will be no interdivisional transaction. This may not be in the best interest of the company as a whole. In this case, In this case, the company CEO we consider, just 1 minute. Let me take a small margin to round up this question. Let me just take this one like this. And leave this one. Oh, sorry. But this was last week. Okay. We are trying to look for margin. Okay. Okay. Bye-bye. So now I'm trying to, okay, is there now? In this case, the company CEO, the company CEO, we consider arrangements for internal transfer that we maximize profits of the company as a whole without demotivating either of the divisional managers. Let me explain this. Two managers are fighting. Remember, they are human beings. And their fight is justified. Electrical division is established to make profit. Break division is established to make profit. So it is natural. Two of them will want to maximize their profits. Break division, we prefer to buy for 500. That will minimize its cost. That electrical unit is the output of electrical division, is one of the inputs of break division. So break division we like to buy for 500 so as to minimize its cost. By minimizing its cost, it can maximize its profits. Electrical division, we prefer to sell for 750 so as to generate higher revenue. Hence, it is possible that the two managers may not agree. And if they don't agree, that means there will be no interdivisional transaction. If there is no transaction between the two divisions, break division, who is operating at 50%, will be losing income because it still has 50% capacity that it can use to produce break. If there is no transaction between the two, the company as a whole is not benefiting. In this case, the CEO will now consider arrangements for internal transfer that will maximize profit of the company as a whole. These arrangements must not demotivate either of the divisional managers. So the CEO, we have to define the arrangements. That we make sure that both managers are willing to transact business with each other. And this question has taken time. It's because we use the question to explain more. Oh. This was 2018. This one was long. I'm not sure we can do any question again. Within 30 minutes.
So we can.
Okay, go and check this question. I think it's in page Abuja Industry. Check this question. I think page maybe 95. So I'm already leaving the class. Page 94, yeah. Question what, please? Yeah, question 6, page 94. Like 4 people have left the class. They are going to sleep. All right, let's look at this question. Once is 11, you shall complete the question yourself. Abuja Industries has several independent divisions. The company's subdivision manufactures a picture tubes. A picture tube used in television sets. The tube division absorption costing income statement for last year, in which 8,000 units, 8,000 tubes were sold, is given below. You have the total, 30 up, and you have per unit. Sales, total sales value, 27,200,000. Sales price per unit, 3,400. You have cost of sales, you have the profits, you have selling and admin expenses, and you have divisional net operating profits. That information is for tube division. As shown above, it costs the tube division 2,100 to purchase a single tube. The figure consists of the following costs: material cost, direct labor cost, production overhead, in bracket 75% fixed. That means variable is 25%. Total cost per tube, 2,100. The top division has fixed selling and administrative expenses of 7 million naira per year. Abuja Industry has just formed a new division called the television division, that we assemble television, a television set that requires a high resolution picture tool. The tube division has been asked to manufacture 2,500 of these tubes each year and sell them to television division. Full stop. As one step in determining the price that should be charged to the television division, the tube division has estimated high resolution tube that will cost material cost for high resolution tube, labor cost for high resolution tube, production overhead in bracket 2/3 is fixed. Examiner says 2/3 is fixed. What is variable? 1/3 is variable. If you are reading question, you must pay attention. You are given the cost of high resolution tube. You have the cost of regular tube. To manufacture the new tube, the tube division would have to reduce production of its regular tubes by 3,000 units per year. There will be no variable selling and administrative expenses on the intercompany transaction, and total fixed overhead cost will not change. Assume direct labor is a variable cost. Requirement A, determine the lowest acceptable transfer price from the perspective of the tube division for each of the new high resolution tube. Who can tell us this answer? What is the lowest acceptable transfer price to the tube division for each new high resolution tube manufacture? What is the minimum price you are going to charge? I'm asking this question to the class. What is the lowest price you are going to charge? If you want to your products, the product from your division to another division. Philips, Meshach.
The minimum price is the variable cost. And for tube, the variable cost there is they said assume labor, that's material plus labor, will be our variable cost, which is 760 plus 540.
No, let's answer it first. Don't make that mistake. You have started well. You know you have two types of tubes. You have regular tubes. Now have new tubes called high resolution tubes.
Oh yes, yes.
Your comment is noted. Yakub, the minimum cost, the minimum transfer price is our variable cost of manufacturing the new high resolution tool. Or you can say the relevant cost of manufacturing high resolution tool. My minimum cost must cover my relevant cost. Sorry, my minimum price. The minimum price I'm going to charge for my products must cover all the relevant costs. So please, why do I pause you, Misha? We have regular tubes. This is the regular tubes. To manufacture my regular tubes, I will incur material cost, labor cost, overhead cost. If I'm to manufacture the new high resolution, look at it, high resolution tubes, these are my costs. To calculate A, minimum acceptable transfer price for new high resolution picture 2. You now look at relevant costs direct material cost 1,200, direct labor cost 980. Examiner gave us production overhead. He now said 2/3 is fixed. Fixed overhead cost is not relevant. Only the variable production overhead cost we are going to pick. The fixed overhead cost is fixed. Examiner says the fixed overhead cost will not change. Any cost that will not change is not relevant to us. You now pick this. 1,000 to 980. Direct material 1,200. Direct labor 980. Variable production overhead. Examiner says 2/3 is fixed. That means 1/3 is variable. 1/3 of 1,080. Let me reconfirm. Look at it, please. Please compute 1/3 of 1,080. What do you have?
360.
360. Thank you, Tolu. 360. But you are not done. There is opportunity cost. Assuming there is no opportunity cost, we'll have just added this and move on. But there is opportunity cost. Now you are going to see Mishak again now. We are safe. Let me move. Let's go on. Look at this last paragraph. To manufacture the new tools, the tube division, we have to reduce production of its regular tubes by 3,000 units. For me to be able to manufacture my new tubes, I'm going to forego existing regular tubes by 3,000. What has happened here? Opportunity cost has happened. I'm going to forget about 3,000 regular tubes. For me to be able to do 2,500 new high resolution tubes. Look at it here. Look at it here. The tube division has been asked to manufacture 2,500 of these tubes. That is the new tubes, high resolution tubes. For me to manufacture 2,500 new tubes, new high resolution tubes, I'm going to reduce the production of regular tubes by 3,000. This gives rise to opportunity cost. You now ask yourself, for the regular tubes, we are going to lose 3,000 units. What is the total contribution loss on regular tubes? By reducing our production by 3,000, that means we cannot make sales for 3,000 units of regular tubes. That means we are going to lose contribution for 3,000 regular tubes. We are losing this contribution because we want to produce new high-resolution tubes. That means there is contribution loss. That is opportunity cost. That opportunity cost, contribution loss, must be added as part of the cost to achieve minimum transfer price. The same thing we did for that first question. You now come to your working year. Working year. Calculation of contribution per unit of regular tube. What is the selling price of regular tubes? Stays 3,400. Then pick variable cost of regular tubes. Material, labor, and variable overhead. 760, 540. Selling price 3,400. Variable cost of regular tubes. We have direct material for regular tubes, 760. We have direct labor for regular tubes, 540. Then variable production overhead. Examiner says 75% is fixed. Look at it here. 75% fixed. That means 25% variable. %25 of 800. Please compute. That is the variable aspect. That should be 200. Is that not?
Yes, 200.
200. Are we done? No, we are not done. When I come here, you are giving selling and admin costs. Total 7.8 million. Total selling and admin expenses 7.8 million. Now look at this place, please. The tube division. as fees selling and admin expenses, 7 million per annum per year. That means if total selling and admin is 7.8 million and fixed selling and admin is 7 million, that means the balance represents variable selling and admin. You must read all your questions, including the figures. So they will just read question. When they get to figure, now say, assume all figure correct. I don't do it so. They say they don't want to waste time. Assume all figure correct. You now come here, look at it. Look at it, please. Total selling and admin, 7,800,000. Fixed selling and admin, 7 million. That means the difference between these two, 800,000, represents variable selling and admin expenses. This 800,000 represents total variable selling and admin. What is variable selling and admin expenses per unit? Yes, Misha.
Sorry, sir. My network was bad. I didn't get that 7,800, 7,800,000 from the question. So my network was bad.
In that question, you have 3 zeros off. I think it's omitted in the question, but this thing should drop. I have limited time. If you watch the question, you have 3 zeros up here. These are in thousands. This is the selling and admin. 7,800. 3 zeros off. But in the question, I think it was omitted. Then look at this place. Fixed selling admin, 7 million. If fixed selling is 7 and total is 7.8, that means variable is 800,000. Now look at it. Examiner says that year, volume of tubes sold and manufactured 8,000 units, in which 8,000 units were sold. That means the company sold 8,000 tubes and incurred variable selling cost of 800,000. What is selling cost per unit?
100.
100, thank you. Quantity sold 8,000 in brackets units. Therefore, variable selling and admin per unit 800,000 divided by 8,000. That will give you 100 naira per unit. You now return here. Variable in unit 100. You can now get your variable cost per unit. 760 plus 540. Please help me add. 760 plus 540. Please confirm you can hear me now.
We can hear you now, sir.
So you have to cost 1,006. Now get your contribution. Selling price 34 minus variable cost 16. Look at it here, please. $3,400 minus 16. That will give us contribution per regular 2 1,000. And regular will reduce by 3,000. Is that we reduce by 3,000. The set of regular tools will reduce by 3,000. Total contribution loss. Total contribution loss. 3,000 regular troops multiplied by 1,800. Please multiply. That will give us
5,400,000.
100,000. That's total contribution loss on regular tools. Now, contribution loss per unit of new tools. This question, if it is texted, there is a lot. I didn't even plan to solve it anyway. It's after 11. But we're almost done. In the next 5 minutes, we should be done. Is this system that just angry? Once you are online and you have so many things attached to your system, the system will drag. All right, look at it.
And maybe you've minimized a lot of things so you can close some windows.
I wish I could. I wish. Look at it. Contribution loss per unit of new high resolution. Resolution 2. I will explain this. Why? I will come back and take you up. I'm trying to create space. I just this was for them. I'll come back here. Let me take this first. Total contribution loss 5,400,000. Number of new high resolution 2,500. Please divide.
$2,160.
2,160. 2,160. Quick. 1,800 is contribution contribution loss per new resolution 2. We are going to lose 3,000 regular twos to produce 2,500 new high resolution 2. The quantity is not the same. So when you get to total contribution loss for regular twos, now new high resolution 2. In this case, this 2,160. Now come back here now. Add contribution loss per new high resolution two, 2,160. Minimum acceptable price. Minimum acceptable transfer price. Please sum up. 1,200. 980. 360. 2,160.
4,700.
1,700.
That is the minimum acceptable transfer price for the new RSO 2. That is the minimum. Two divisions we are set. For me to say minimum, I can say I'm going to take my relevant cost, my variable cost, plus the, if I accept to do new high resolution 2, I'm going to lose contribution on my regular tools. That will be fashioned into this. To round up the question, look at requirements, second requirement. That as found an outside supply that will provide the new tubes for 4,000 naira each. If the tube division makes this price 4,000, what is the effect on the profit of the organization? When you manufacture for 4,700, you now sell for 4,000 naira. What happened to your profits? Hello. Your relevant cost of manufacture, relevant cost of manufacturing new high resolution 2 is 4,700. You now agree to sell, to try for 4,000 naira. What is the effect on the profit of the company? The profit is reduced by 700 naira. It doesn't require too much thinking. Look at it. Requirement B. Outside supplier price 4,000. Minimum acceptable price 4,700. Reduction in contribution. 700. If two division agrees to a transfer price of 4,000 naira, comma, the profits of the company will reduce by 700 naira per unit of new high resolution 2. Total reduction in profit is you are going to manufacture 2,500 units and you are going to lose 700 naira. Please multiply. Fine. Multiply by 7.
1,750,000.
Thank you. Profit of the company will reduce by 1,750,000. If you agree to meet external supplier quotation, what you are going to manufacture for 747, you agree to transfer as 4,000. Profit will reduce by 1.75 million. We extended by 15 minutes or 17 minutes. Please review this material. We move to the next topic next. Any question, clarification? Will that give us a better understanding? When you go to review your material and check past questions. If there's no question, I'm checking out. Good night.